Well, overall, stocks starting off the year in the green. The Russell already up 5%, and it's only January 8th. Small caps take the lead, at least so far. Is 2026 shaping up as a different kind of market year? And do investors need to move out of big tech and look broader? Joining us now is Richard Bernstein, advisor, CEO and CIO Richard Bernstein, and Regions Wealth Management CIO Alan McKnight. Guys, welcome. Alan, we just heard about what's happening in metals. We also heard, GM following Ford backing away from EVs. Does this affect your big picture thesis on 2026 at all?
It really doesn't. In our view, the consumer remains in good shape. And if you can see earnings come through the way they've been trending over the last couple of quarters, where estimates continue to uptick, and you see this growth overall with operating margins staying very stable, we feel pretty good about the economy. Now, there are going to be some of these outliers, such as what we heard from GM, that's going to be a little problematic and adds more vol to the markets. But underlying, we think the economy is pretty strong.
Okay. And Richard, welcome. We got these high valuations now. Sports betting's a new asset class. The story that drove this bull market in AI might be shifting. What should investors do differently, if anything?
So, John, I think that for 2026, investors should kind of focus on boring investments. I know that's not what everybody wants to hear, but boring investments. I think people have completely forgotten about dividends and the extreme power of compounding dividends through time, as well as quality and international diversification. I mean, it's incredible to think that the non-U.S. markets significantly outperformed the U.S. last year, and nobody cares. This is sort of like the beginning of the bull market in the United States in 2010, 11, and 12, when the U.S. was outperforming, but nobody believed it. They all thought you had to invest outside the United States. And now it's kind of turning around. So we think, basically boring fundamental type stuff is what people should be looking for. And I think anytime we see a broadening of the market that you were just talking about, I think investors should fully embrace that. That's the real fundamental story. The Mag 7 have not been the only growth stories in town. There's been many, many growth stories. So it's actually quite encouraging to see the market broaden, because maybe investors are starting to pay attention to that broader fundamental story.
Yeah, along those lines, Alan, I mean, you have an equal weight S&P that outperformed other averages today. You have a Dow Transports average that is at a record high, 1.1% higher today. How does that speak to this broadening out and to the comments you just made about the state of the economy?
We think it's real positive because it's exactly what Richard talked about, which is when you start to see this broadening occur, more sectors, 9 out of 11 today, hitting new highs and actually hitting what we would see as being more realistic targets after having been sort of in the doldrums through 24 and into 25. That's a net positive. And it's almost this Occam's razor view of the most simple explanation is probably the right one. If you can continue to generate earnings and cash flow, you're going to be rewarded, even with valuations where they are.
Rich, you talk about boring is beautiful. Is that the case just in equities, or is that the case in other asset classes as well? I mean, we were just talking about metals, golds, silver, precious metals. They've had a crazy couple of years now, particular 2025. And the credit market is rocking and rolling right now, too. Huge issuance to start the year.
Yeah, so Morgan, I think you're right. That this boring is beautiful story is more than just equities. In fixed income, I think our firm, Richard Bernstein Advisors, is light years out of consensus in that our fixed income portfolios have no credit risk whatsoever embedded in them right now, no corporate credit risk whatsoever. And the reason why is because credit spreads are not quite, but almost historically narrow. You're not being compensated for the risk. And historically, when that's happened, it hasn't really paid to be in credit. So we understand the long-term story of credit. I mean, I was one of the first people to write about this 30, 40 years ago. I get that. But entry points are very important. It seems like it's not the right time to take credit risk. In terms of gold, we actually view gold as being pretty boring. I know nobody else does. But we tend to carry a relatively consistent allocation to gold as kind of the spare tire in our portfolio. Why do you have a spare tire in your car? Because you can never anticipate a flat tire. We have gold in the portfolio because you can never anticipate uncertainty.
It's a very nice and expensive spare tire right around now. Alan, finally, the NASDAQ peaked right around 24,000. Is the AI trade changing right now? And if so, what happens to these derivative plays in like energy, construction equipment, not exactly about the core technology?
We think it's changing. And I think that's the key to the market over the next 2 years, really, is this transition from throwing all the money at it and just assuming something's going to work out, and instead moving into some of the peripheral opportunities, not necessarily electrification as much as we've seen of late, or necessarily on some of the data centers. We've heard some of the news of late regarding municipalities and some of the challenges associated with that. So what we'd really like to see is more investment in the core infrastructure without necessarily having to go out quite as far on the periphery in terms of some of these smaller names that have really been juiced and ripped over the last year.